All right, good morning, everybody. Today we are looking at AASB 3 business combinations. This is a standard that was reissued a few years ago and often still is a problematic standard. So that's why we're looking at AASB 3 today. Before we start, I thought let's do a bit of a quiz just to get everybody going. You can do your quiz on a piece of paper. You can send me your answers as well if you want to. But 5 questions. Let's see how we go. Other than Canberra, which is the only other Australian state or territory capital that's not named after a person? So there's Perth, there's Hobart, there's Melbourne. What do you think? Which one? You can send me your comments if you want to. You see, I'm an immigrant, so I enjoy these kind of questions because it teaches me a bit of Australia. Fantastic. Very interesting. I think most of you have it right. Very interesting. So the answer to that one is number A, and it's Perth. So Perth is the only other capital that's not named after a person. Very interesting. The second one, what is the currency of Malaysia? So the world is getting smaller. Oh, beautiful. Hendra, you've got it right. Oh, Margaret, you've got it right. Ben, you too. It's number B. Now, I don't even know how to pronounce number B. But yes, it's number B. Is it ringgit? That is the currency of Malaysia. I've never been to Malaysia. Would love to go there because I love Malaysian food. Number 3. Who was awarded the Norm Smith Medal for the best player in the 2008 AFL Grand Final? Can any of you remember who won the Grand Final? Ah, the footy people are on to this. They can remember. Yeah, fantastic. So it is number A, Luke Hodge. And it's 2008, best player, and he's still playing. And still a fantastic player. I like him. Number 4, in which event did Australia's Steve Hooker win a gold medal at the Beijing Olympics? I know this one because I'm a bit of a sport addict, and my son did an assignment on him. Yes, number B, pole vault. And then in number 5, last question to get us going, get to the accounting stuff. Which national Aussie sporting team has adopted the nickname the Diamonds? So we've got the Socceroos and we've got all kinds of other nicknames. Yes, a lot of the ladies have this one right. Correct. It's netball. They're the Diamonds. Fantastic. Maybe because women like diamonds or ladies like diamonds. So that's just to get us going and to use the question box today. So let's go back to business, the accounting business. So the roadmap for today's session, after we've had a bit of a warm-up, the roadmap for today's session is that we'll be looking at 3 parts. Number 1, we'll look at the core principle in AASB 3, but then we'll also look at some AASB 3 issues and examples. So I've tried to look at common questions that people ask us in the technical team. And so let's address some of these common issues and provide some examples. Most of them relate to the changes that was made in AASB 3 revised a number of years ago. And then the last section you might find a bit surprising, but I want to look at some AASB 1 to 7 issues and examples because they really go hand in hand with AASB 3. So let's extend it a little step further. So it's really today about what are the core principles when we look at AASB 3, a bit of a revision, and then look at some issues and do some examples. So there's quite a number of examples in today's session. So if we look at the core principle in AASB 3, the core principle is an acquirer of a business recognizes the assets acquired and the liabilities assumed at their acquisition date fair values, and then discloses that information that enables the users to evaluate the nature, the financial effects of the acquisition. So when I look at that core principle, which is just one sentence, to me there's three parts that stand out. And the one is it's an acquirer, and it's all about how the acquirer will account for this business combination. So it's got nothing to do with the acquiree. They go on business as usual. They don't care who their shareholders are. They go on. So it's all about the acquirer. How would the acquirer account for the business combination? The second key thing is we need a business. The acquirer need to acquire a business. If it's not a business, it's not AASB 3. It's not within the scope of AASB 3. And then the third thing is the acquirer will recognize all the assets, all the liabilities at their fair values. So irrespective of whether the assets and liabilities are in the records of the acquiree at cost or fair value, doesn't matter. The acquirer start fresh at acquisition date that bring in assets and liabilities at fair value. And it's very important to note that the acquiree go on with business as usual. Nothing changes in the books of the acquiree. But from an acquirer's perspective, we now start fresh with fair values of assets and liabilities. So those are like three key steps within AASB 3. AASB 3 says we apply the acquisition method. That's the key thing. And if you break it down, what does the acquisition method mean? And if you break it down into 4 steps, we would say the first thing is to identify the acquirer. So if two entities get together and one would buy the other, usually it's fairly easy which entity is the acquirer, but sometimes it's not that easy. But it's very important that we identify an acquirer. There has to be an acquirer. We no longer have a merger of interest or pooling of interest. We have to identify who is the acquirer. And then the standard does give us some guidance on how do you identify the acquirer. And the guidance is in the appendix. All the good stuff these days are in the appendix. So if you want to identify the acquirer, you go and look at Appendix B, and you specifically look at paragraphs B13 to B18. And some of the things we'll be looking at is they say you look at the relative voting rights in this combined entity. So whoever has the biggest percentage of voting rights would usually be the acquirer. You would look at the existence of a large minority voting interest in this combined entity if no other owner or organized group of owners has a significant voting interest. And you would look at the composition of the board or the governing body. So who would appoint most people to the board or the governing body? You could also look at the composition of senior management of this new entity. So who appoints the majority of senior management? And you would also look at the exchange of equity interests. So they say the acquirer is usually the combining entity that pays a premium over the pre-combination fair value of the equity interest of other combining entities. So the acquirer will have to pay something extra, a bit of a premium, to get hold of the acquiree. So there's quite a bit of guidance on identify the acquirer. The second thing is we have to identify the acquisition date. Now, why is this so important? Because if we get the acquisition date wrong, we would determine fair values at the wrong date. Remember, at the acquisition date, we determine fair values of assets acquired and liabilities assumed. So it's important to identify the acquisition date. And the standard says in paragraph 8, the acquirer shall identify the acquisition date, and that is the date on which the acquirer obtains control of the acquiree. They go further to say that the date on which the acquirer obtains control of the acquiree is generally the date on which the acquirer legally transfers the consideration acquires the assets and assume the liabilities. So usually that would be when we transfer the consideration. So again, a bit of guidance on the acquisition date. The third thing we're looking at is we have to recognize and measure the identifiable assets acquired and the liabilities assumed and any non-controlling interest in the acquiree. And the assets and the liabilities have to be at fair value. And an important thing here is, even if the acquiree did not account for the assets, or even if the acquiree did not account for the liabilities, the acquirer come in and according to acquisition method, they account for all assets, all liabilities, whether they've been accounted by the acquiree in the past or not, and they account for all those assets and liabilities at fair value. Therefore, it usually takes quite a bit of an exercise to determine fair value at the acquisition date. And then the last thing is, if we compare the consideration with the fair value of what we've purchased, there could be a goodwill or there could be a gain. How do we account for that? A goodwill will end up in the balance sheet, and forever, every year, we'll have to do impairment testing of that goodwill. If it's a gain, and that's a scary bit, if it's a gain, they say go and retest, reassure, reconfirm that it is a gain, that you didn't miss an intangible asset, that you didn't miss anything else. Just redo the calculation, make sure it is a gain, and then that gain goes into profit and loss in that year immediately. And that's why we have to be so careful to make sure it really is a gain, because it hits profit and loss immediately. So that's about the acquisition method and the core principles. So if anybody asks you, listen, what is AASB 3 about? I would say AASB 3 is all about acquirer, obtaining or buying a business, key that it's a business, and it's important that acquirer in their books account for all the assets, all the liabilities at fair values at the date of acquisition. That's the key principles that we've got in AASB 3. Now, AASB 3 does lead us to some key questions, issues, and therefore I'm going to look at a few of them. Maybe just a bit of a step back. What is the business combination? AASB 3 accounts or deals with business combinations. Now, what is a business combination? It's a transaction or an event in which an acquirer obtains control of one or more businesses. So it's really important. You can see in this definition there's this emphasis on businesses. So the definition of a business is very important, and because the definition is so important, it's not in the body of AASB 3, it's actually in Appendix A. I never understand it. You know, key definitions are, chucked away in the appendix. But anyway, that's just my personal little gripe. What is the definition of a business? A business is an integrated set of activities and assets that is capable, and I want to emphasize, capable of being conducted and managed for the purpose of providing a return in the form of dividends, to lower cost, or any other economic benefits, directly to investors or other owners or members or participants. So if you go and you buy a group of assets and activities, even though they're not run as a business before you buy it, if that group of activities and assets is capable of being run as a business and capable of lowering costs and capable of providing some other benefits to the owners, that is a business. So it's all about capability, not current use. The other things, assets and activities need not be conducted and managed as a business at the acquisition date. Doesn't really matter how it's currently or before the business combination conducted or management, as long as in the future it can be or it's capable of being conducted as a business. So really important that we pass this threshold. Did the acquirer buy a business, yes or no? Now, why is this definition of a business important? Because if we say yes, we've purchased a business, Then it's a business combination. Then we apply AASB 3, which means the acquisition method, which means the assets and liabilities of the acquiree are fair valued. If it's not a business combination, it's just a normal asset acquisition. And how would we account for it then? So usually if you buy an asset in terms of AASB 116 property, plant and equipment, let's say a property, you would say credit cash, debit property, plant and equipment. Or if you buy an intangible asset, you would say credit cash, debit intangible asset. So that's when it's an asset acquisition. However, if it's a business combination, if you apply AASB 3 and you use the acquisition method, you'll come up with fair values of assets and liabilities that you've acquired. Plus, there could be a goodwill at acquisition date, or there could be a gain on acquisition. Right, and that gain on acquisition could end up in your profit and loss. So it's really important to know whether it's a business or not. It has a huge impact on the accounting treatment. It actually determines whether AASB 3 is applicable or not. So let's look at a few examples to take this definition for a test drive. So in the first example, I said, let's say we've got an IT department. The IT department is a cost center to K&K Co., a legal firm. Now, IT Outsource Limited specializes in the provision of IT services to legal firms. Now, K&K Co., the legal firm, decides to sell its IT department, or its cost center, to IT Outsource Limited, and it consists of plant and equipment, working capital, and staff. So the whole IT department is now sold to IT Outsourced. The assets and the staff transferred to IT Outsourced Limited is capable of being operated as a business, because we can take the assets, the equipment, the working capital, the staff, and we can provide these IT services to various law firms. So in this situation, can IT Outsource Limited say that they've acquired a business? What do you think, yes or no? Please send it through. I'm keen to see your responses. Let's get the fingers going. Fantastic. So Wayne said yes, Anthony yes, Hendro yes, absolutely. In this situation, we would say yes, it is a business combination, we'll apply AASB 3. So what about the next one? Example B. Let's say company E's financial statements or assets contain the following. Contains assets of, there's electricity grids, we've got a tracking system, we've got working capital, and company A acquires from company E the electricity grids and the tracking system for 14 million. Sorry, Jennifer said that she can't hear me. Jennifer, I'm sorry, I don't know what the issue is. I haven't had any other comments. Maybe I'll send you the link to the recording anyway afterwards. I don't know what else to do, Jennifer. Sorry. So company A acquires from company E the electricity grids and the tracking system for a price of 14 million. Now, if we consider, and you have to consider the relevant industry, and certain industry requires relatively low inputs of working capital and labor. So you have to consider within this, you have to consider the industry and the requirements of the industry. And in this situation, say, do you think company A acquired a business? What do you think? Come on, send me some ideas. What do you think? Fantastic. Wayne's fast. Yes, Sam. Nicole, fantastic. A lot of people quite fast. Yes, this is a business as well. So we're looking at the electricity grids. We look at the tracking system. The two together can operate as a business. It's capable of being run in a business. Within that industry, it's quite acceptable to buy something like that. What about this one? So this is for our friends there in Western Australia and maybe up north in Brisbane. Let's say Company a mining entity, buys a new mining tenement that is in its early development stage, and the mining tenement can constitute as a business even if production has not commenced. So we're buying a mining tenement, it's in the development stage, and this is a bit of a tricky one, so I thought I'll give you some guidance or help you that although this mining tenement is not in production, it's still in development, I believe it could be a business. It's capable of being run as a business. I mean, a lot of listed companies, junior explorers, buy mining tenements, they develop it, and they would argue they're buying a business. Oh, look at this one. Company A buys Company B, and the only asset that Company B has is a mining license. In this situation, do you think Company A is buying a business? Right, so you have to be very careful. A lot of people look at this and they say, Company A buy Company B. Obviously, if you buy a company, you have to be buying a business. That's not necessarily true. Company A buys another company. Company B is not a business at the moment. The only thing that we've got in Company B is a mining license. They're not developing, they're not doing anything with it. So basically, the only reason Company A is buying Company B is to get hold of the mining license. Therefore, this is not a business combination. It's not a business. It's the acquisition of an asset. We would say credit cash, debit mining license for the whatever we pay, and that's it. This has a very important implication for a lot of entities who want to list, and instead of just listing and going through all the costs to list, they often say, let's get a listed cash shell to buy us. And it's called a reverse acquisition, because really the trading entity is the real acquirer and the listed cash shell is the acquiree. You have to be careful. That acquiree, the listed cash shell, if there's nothing in that listed entity, there's just cash in it, it's just a dormant entity. That dormant entity is not a business, and therefore you will not apply AASB 3 in that situation. So you have to be careful. It's really important that we consider, are we acquiring a business, yes or no? The next thing that I want to flag, which does provide a lot of issues in practice, is the common control exemption. Now, AASB 3 in paragraph 2C states that AASB 3 does not apply to a combination of entities under common control. And that's a paragraph that's often read and overlooked, because I think we are so eager to apply AASB 3 and start with all the fair value calculations that we often overlook this paragraph, in a small little paragraph on the first page of the standard. So when would entities be under common control and therefore outside the scope of AASB 3? Now I've got a little diagram here where I've said, let's say we've got parent A with two subsidiaries B and C, and there's a few sub-subsidiaries. What if subsidiary B decides to buy sub-subsidiary F from subsidiary C? So if you look at that, the acquirer, subsidiary B, is controlled by parent A, and the sub-subsidiary F is controlled by parent A. Therefore, both entities in this transaction are controlled by parent A. Therefore, we've got common control, therefore AASB 3 will not apply, or would usually not apply. This is a very tricky area. Why do we have to be careful here? Because we don't want entities within a group to buy each other and get to the recognition of goodwill or get to the recognition of gain on acquisition, or get to a situation where we are fair valuing assets and liabilities which shouldn't be allowed under normal circumstances. So it's very important that you get a picture of the whole group and consider whether the two entities in the deal, the acquirer and the acquiree, is not maybe under common control. You have to be very careful with this one, because in the old days we would have said this is just an internal reorganization. And if we are just doing an internal reorganization, AASB 3 should not be applying. So be careful with common control. Now, I often get asked the question, does common control exemption also apply to individuals? What if we've got two companies, company A, company B, and they've got the same shareholders? And now company A decide to buy company B, but remember they both have the same shareholders, or maybe the majority of their shareholders are the same. Could we argue that's a common control transaction? And I would say yes. You know, you don't only look at common control by companies, but is it under common control of individuals or key individuals? You would consider that. So really, what I wanted to say before we start with the details of AASB 3 is there's a few key considerations before we apply AASB 3. And the first thing is, did the acquirer buy a business? And if we say no, we didn't, then we do not apply AASB 3. If we say yes, we've acquired a business, we would say, are the acquirer and the acquiree under common control? If we say yes, they're under common control, it actually leaves a bit of a question mark. How would we account for it? But we would definitely not automatically apply AASB 3. It's a bit of a question mark. If we say no, it's not under common control, yes, now we can apply AASB 3. I think in the past we might have been a bit over-eager to apply AASB 3. So you have to look at this. I want to come back to do not automatically apply AASB 3. What do I mean by that? Because business combinations under common control are scoped out of AASB 3, a lot of people argue if it's under common control, you would never, ever, ever apply AASB 3. Other people argue, listen, there's no other standard dealing with business combinations under common control. It's on the agenda of the International Accounting Standards Board, but currently there's nothing. Therefore, we have to apply the closest standard, and therefore the closest standard is AASB 3. There's a third view, which I share, where we say we have to look at whether there's substance to the transaction. If there's substance to the transaction, therefore there are third parties involved, there's fair values, that's genuine, that can be bounced off the market, that relate to the market. So there's a few indicators to consider. If there's substance to this transaction under common control, I'm happy to apply AASB 3. But if there's no substance, definitely not AASB 3, and we would just account for it as carrying on and carrying assets at carrying amounts, no goodwill, no gain. So there's a bit of a question mark on common control. Another issue is transaction costs have to be expensed. So if you've got acquisition-related costs, have to be expensed in the periods that they are incurred. So this would be finder's fees, advisory fees, legal fees, accounting fees, valuation and other professional or consulting fees, cost of internal acquisition departments, all of those have to be expensed. Years ago, we were able to capitalize that as part of goodwill, but now these days it has to be expensed. So please note, transaction costs have to be expensed. There's one exception to this rule, and that is the cost of issuing debt or equity will continue to be offset against the proceeds of that issued debt or issued equity, and that is in accordance with AASB 132 and 139. So we still have that exception. AASB 3 have extensive application guidance on how to determine acquisition date fair values of assets and liabilities. So there's specific application guidance on, separate valuation allowances for assets with uncertain cash flows, application guidance for assets that are subject to operating leases, in which the acquiree is the lessor, and also assets that the acquirer intends not to use or to use in a way that's different from the way that other market participants use them. So if you want to look at acquisition date fair values of assets and liabilities, there's a lot of guidance within AASB 3, so please have a look at that. Another big thing in AASB 3 is that we now have the option to gross up goodwill for non-controlling interest. And this is an interesting one because in the past, in America and US GAAP, they used to gross up goodwill. And in the rest of the world, in IFRSs, we didn't gross up goodwill. We calculated goodwill as a percentage of the net assets acquired. After this convergence project between the US and the International Accounting Standards Board, they now give us two options, and it's a choice. You could either have goodwill as a percentage of net assets, or you could gross up goodwill. Now I want to show you what that means in an example. So what they are saying, the acquirer shall measure any non-controlling interest. In the past we talked about this as minority interest. You would account for non-controlling interest or NCI as either at fair value or for the non-controlling interest proportionate shares of the acquiree's identifiable net assets. So fair value, to have NCI at fair value is how they've always used it in the US, and to have it as a percentage of net assets is how we've used to have it in Australia. So let's look at an example. In this example, I've got company Z acquires 80% of company Y, and they pay $100,000 for that 80%. The carrying value of company Y's net assets at the time of acquisition equals $80,000. So the net assets are $80,000. For 80% of that, we are paying $100,000. And the fair value of the net assets are also $80,000. So we're basically saying the carrying value, the fair value is the same, so we can have an easy calculation in this instance. So how did we previously measure goodwill and NCI in Australia? We would say consideration for the 80% was $100,000. We would have said the fair value of the assets we've acquired, that 80% of the assets was $64,000. Therefore, we would have said goodwill was $36,000. So we said $100,000 is what we've paid for 80%. 80% of what we purchased was $64,000. Therefore, goodwill had to be $36,000. So our journals would have been debit the net assets $80,000, debit the goodwill $36,000. Credit what we've paid $100,000, and we would have had a non-controlling interest, which is 20% of the net assets. Can you see? It's a proportionate share of the net assets, $16,000. Please note that this option of what we've always done in Australia is still allowed. It's still an alternative in AASB 3, so you can continue with this. However, the new AASB 3 has given us another option, and it says you can also measure goodwill as at the fair value and include, you can gross up goodwill and therefore bring in NCI at its fair value. So what would that calculation look like? You would look at the fair value of what you've paid. You would say include the fair value of NCI, and that would now be the fair value of the consideration is the fair value of the 80%. You would add the fair value of the remaining 20%, and from that you would deduct the fair value of all assets of 100% of the assets and liabilities, because we have to compare apples with apples. If we are bringing in fair value of consideration plus fair value of NCI, we are bringing in fair value of 100%. Therefore, we have to compare with that fair value of 100% of the assets, and that would give us goodwill. So if we do this in this example, we would say the fair value of the consideration is $100,000. That's what we paid for 80%. And let's say the fair value of the NCI is 25%, $25,000. How did I work that out? I've made the assumption, just to do this question, which is not always the case, this assumption is not always right in practice. I've made the assumption that if we've paid 100,000 for 80%, we would have paid 25,000 for 20%. Now, it could be that that remaining 20% of NCI has a higher fair value because we want to get to 100% so we can use tax consolidation. Or it could be that that fair value has a lower, that NCI has a lower fair value because we already have control. We don't mind about 100% control as long as we have control, and maybe in practice that fair value could be less. So I've just made it, that it's a similar percentage. So if you look at the total fair value, it's 125,000. You compare that to the fair value of net identifiable assets, which was given as 80,000, and now goodwill is 45,000. So what would the journal be in this alternative? We still have net assets of 80,000. We now have goodwill of 45, which is grossed up. We still have consideration and credit of 100,000. And can you see our NCI is now not a percentage of net assets. Our NCI is now at fair value. So if we compare the two alternatives, the previous option, which we can still use, we've got consideration of 100,000, fair value of the 80% is 64, goodwill is 36, and you can see the journal. The new option, the old US option, what's different? Goodwill is now 45 instead of 36, net assets stay the same, considerations stay the same, and NCI is different. Non-controlling interest in the previous option, which is still allowed, is as a percentage of the assets, where with the new American option, NCI is at fair value. And you've got a choice on which option you want to use. So you have to make this decision. If you've got a business combination, which one you want to use. So that's the first thing I just wanted to flag and put out there. The other thing is, under the application of AASB 3, more intangible assets are being recognized. Because in the past, there was this requirement that you would only recognize assets and liabilities at acquisition date if you could reliably measure it. The new AASB 3 have said, no, we don't care about reliable measurement. Estimation is an essential part of accounting. Therefore, you do the best you can to come up with a measurement, and you account for your assets and your liabilities at that measurement. So that led to more intangible assets being recognized, because in the past it was so easy to just say, I cannot reliably measure it, and we're not going to do it. So there's a lot of emphasis that you have to do whatever you can to come up with an estimate of what the assets and liabilities are worth at acquisition date, come up with a fair value. Now this is an interesting one, the next one. And that is, there are possible profit implications when we obtain control of a company in which we previously held a non-controlling interest. Now this is an interesting one. So if in the past we had a 10% interest or 5% or some interest, we didn't have control, and after this acquisition, a new acquisition, we have control, there's a possible profit implication in our statement of profit and loss and other comprehensive income. So this is where we've achieved a business combination in stages. So in a business combination achieved in stages, the acquirer shall remeasure its previously held equity interest in that acquiree at acquisition date fair value, and if there is a gain or a loss, we have to recognize that gain or loss in profit and loss. So there's a possible profit or loss implication. So what does this mean? It's possible to generate a profit or a loss by obtaining control of an entity where we've previously held just a normal investment, or maybe in the past we had significant influence. Therefore, auditors and clients, you have to be very careful. if you go from a normal investment to control, or subsidiary, or significant influence to control, there's this possible profit or loss implication. So what do I mean? Let's look at an example. In this example, I said in the year 2000, Company X acquires a 10% shareholding in Company A, and it cost them $1,000. So for 10% shareholding, we paid $1,000. It was just a normal shareholding. So we would have said credit cash, debit investment in shares, $1,000. In 2009, Company X acquires the remaining 90% of Company A for $18,000. Now, I'm just saying we buy everything to get to 100% to make my example easy, but even if you just went up to control, whatever that percentage is, remember there's no clear bright line for control anymore in AASB 10, but as soon as you go from 10% to control, whatever percentage it is, this principle will apply. I'll just try to keep it simple. The fair value of the net tangible assets of Company A at date of acquisition in 2009 is now $10,000. So you have to say, in 2000, I bought 10% and the cost was $1,000. But now we would say, what are the fair value of net tangible assets at the date of acquisition? It's $10,000. Now, Company X accounted for this investment in Company A at cost, so it kept that $1,000 in its book over all the years. Right, so when we obtain control of the company in which we previously had a non-controlling interest, we have to work out consideration. And we'll have to say consideration consists of the fair value at 2009 of that 10% shareholding. And we'll say this in consideration is for the 90% shareholding, we paid $18,000. So if we paid today $18,000 for 90% shareholding, what would we have to pay today for that 10% shareholding that we bought in the year 2000? And you would say, listen, if we bought it today, we would have paid $2,000 for it. And we base it on what we currently and today paid for the remaining 90%. So the consideration is not only what we pay today, the $18,000, we also gross up that 10% that we've had for a number of years. So consideration is now $20,000. And now goodwill is that consideration of $20,000. I've said in the question the fair value of the net assets that we've acquired is $10,000. Therefore, goodwill is $10,000. All right, so consideration is not what we've paid today, but it's also the fair value of what we've purchased years ago, and goodwill is $10,000. So let's look at the journals. So years ago, when we purchased that investment, we said credit cash $1,000, debit investment $1,000. What do we do now? We would now say, listen, we now have to consolidate and bring in the assets at fair value, so debit the assets at fair value. We've calculated goodwill to be $10,000, so debit goodwill $10,000. We'll say credit cash $18,000, so that's the $18,000 that we've paid, today. We will say credit that investment in Company A, which we've created in the year 2000, because we no longer have an investment. We now have all the assets, all the liabilities, we're consolidating. So if you look at that initial journal, that investment at $1,000, we have to get rid of it, because we now actually accounting for all assets, all liabilities. And then we're saying we recognize a profit of $1,000. So where does that come from? That means that an initial investment of $1,000 now have a fair value of $2,000. Therefore, the fact that we bought it years ago saved us money today, and therefore we credit a profit of $1,000. Fascinating stuff. So how can we prove this profit of $1,000? You can say that initial investment cost us $1,000. The fair value of that investment today is $2,000. Therefore, the profit that we recognize today is $1,000. So if the stock market moved against you, this could very easily be a loss. But can you see, if you go from a position of I've got some shares but I don't have control to a position where I buy more shares and now I have control, there's a possible profit or loss implication. So you have to be careful and on the lookout for this. What about another company? What if we say it's a similar example, very similar, but I said in the year 2000 we acquired a 10% holding in company A. In 2009 we buy a remaining 90%. The fair value of the assets and liabilities is 10,000. The only thing different in this example to the previous one is we didn't account for the investment in the shares at cost. We account for it as an available for sale investment in terms of AASB 139. Therefore, every year we would have fair valued that investment. And when you fair value an available for sale investment, the credit would have gone to an AFS revaluation reserve. So what would happen in this situation? All the other facts are the same, but we didn't carry the investment at cost, we carried the investment at fair value. So the calculations are the same. The consideration is still a total consideration of 20,000. Goodwill is still 10,000. Our initial journal when we purchased the investment would have been debit the investment 1,000, credit cash 1,000. When we revalued that investment over the years, we would have said debit investment over the years 1,000, and we would have said credit and AFS revaluation reserve 1,000. So I understand this would not have happened in one journal. It's a summary of all the journals over the years. So now when we buy the remaining 90%, what would we do? We would say debit the assets, 10,000. We would debit the goodwill, 10,000. Credit cash, 18,000. And we say we have to get rid of this investment. And this investment is now in our books at 2,000. If you look at the previous journal, initially we brought it in at 1,000 and then we've increased it with a further 1,000 to keep it at fair value. So get rid of that investment at 2,000. And then we say, listen, there's a problem here. We also have this AFS revaluation reserve. We want to get rid of this AFS revaluation reserve because we now consolidate this entity. So in terms of AASB 3 paragraph 42, we would say debit the revaluation reserve and credit profit. So the net effect of these two journals are exactly the same as the journal we did in example F. It's just a longer way because we've revalued the shares between 2000 and 2009. So whether we've had the shares at cost in example F or whether we've had the shares at fair value in example G, we have a profit and loss and a loss implication when we now have control of this entity. So that's just two examples to contrast the two. Please note, there are no profit or loss implications or additional goodwill with the acquisition of additional holdings in a controlled entity. So what does this mean? If we've got a 60% subsidiary and we then buy an additional 20% in the subsidiary, there's no profit, there's no loss, and there's no additional goodwill. So if you go from control, we have a subsidiary, we control the subsidiary, and we buy a little bit more in that subsidiary, you don't have a profit and loss implication, you don't have a goodwill implication. Right? You only have this additional goodwill or this goodwill implication or this potential impact on profit and loss when you go from no control to control. So that's very important. So I try and illustrate that in this example. So this one I say Big Limited has a 51% holding, so they've got control. Let's say 51% is control. They buy a further 29% for 58,000, and so they still have control. So in the past we had control and we accounted for the net assets, and we had an NCI of 49%. And now we buy a bit of that NCI. So what do? We debit NCI because NCI goes down. the non-controlling interest is going down. We pay out cash of 58,000 and the balancing figure is a deduction of equity. So in this situation, there's no profit and loss implication, there's no goodwill implication. Another thing to consider, if we make adjustments to contingent consideration after 12 months, after the acquisition date, that adjustment to contingent consideration is adjusted in profit and loss. It's not adjusted in goodwill. So an example, if company A paid $150 to acquire company B, and the fair value of the net assets of company B is 100, and they say if company B meets certain profit targets over a 3-year period, company A will pay another $50 at the end of year 3. At the date of acquisition, we'll say the likelihood of company B meeting the profit targets is 75%, and there's a discount rate of 10%. Now, in this situation, at the date of acquisition, we will say what is the present value of that contingent consideration of 50. We'll say $50, there's a 75% likelihood. We'll discount it over 3 years. So that is, we divide it by 1.10, which is the discount rate for 3 years. It gives us present value of that contingent consideration on day 1 is 28. So on day 1, we are saying we're paying cash of 150. We have a contingent liability of 28, which is the net present value of what we expect to pay in 3 years' time. And we use that to work out, we buy net assets of 100 and goodwill is 78. What if at the end of year 2, we realize that the likelihood of company B meeting its profit target is only 25%. So initially at the end of year 1, we worked on a likelihood of 75%. But now at the end of year 2, the likelihood is only 25%. We would say recalculate the fair value of that liability. Say $50 is the contingent consideration. The likelihood is 25%. We have to discount only over the remaining 1 year, and therefore the fair value of the liability is 11. Important that you don't compare that 11 just with the 28 that we had on day 1. You have to remember that every year we will restate that contingent liability. And at the end of year 2, if we worked on the normal probability of 75%, this liability would have been $50, 75% liability, there would have been a discount of 1 year, the liability would have been 34. However, because the probability changed to 25%, the contingent liability of 34 changes to 11. Therefore, how do we do that? We debit the liability with 23 and we credit profit or loss with 23. The key thing here is that we do not credit goodwill, we credit profit or loss, because this adjustment happened after 12 months after the date of acquisition. The other catch is to not compare the liability of $11 with the liability at date of acquisition. You have to remember that that contingent liability would be recalculated and restated at every reporting date, at the end of year 1, end of year 2. Income taxes. If we make an adjustment to deferred tax benefits that's potentially realized, if we make it within 12 months, the measurement period, we could reduce or adjust goodwill. If it's after 12 months, it goes to profit and loss. So if we look at a little example for that one, let's say on the 1st of January year 10, we buy Z Limited for $1 million. A Z has 500,000 worth of tax losses, and on acquisition date, it is less than probable that those tax losses will be utilized. And therefore, at acquisition date, we don't book a DTA, because we always have to look at whether there's the probability that we would be able to utilize those tax losses. However, 2 years later, we assess that it's now probable that the losses will be utilized. What do? Because it's 2 years later, if you look at the previous slide, that adjustment will go against profit and loss and not against goodwill. So what is the journal? We would say we can now recognize a DTA, so debit a DTA in year 12 of 150,000 or 500,000 multiplied with 30%, and we credit an income tax expense of 150,000. So it's adjusted against profit and loss and not adjusted against goodwill because it happened after 12 months after the acquisition date. It's outside the measurement period. What about indemnification assets? Indemnification assets are recognized at fair value on the same basis as the related liability for this indemnified asset. So this is if there are uncertain tax positions, if there are certain environmental liabilities or legal matters. So we create a liability at the date of acquisition, and if there's a possibility that we'll be able to get the money back from an insurer, for instance, we could create an indemnification asset. You don't net it off against the liability. It's a separate indemnification asset. And the same principle, if that indemnification asset, if the measurement of that indemnification asset changes after 12 months of the date of acquisition, you would adjust it against profit and loss. If it's within the first 12 months, within the measurement period, you can adjust it against goodwill. Now again, I've got an example to try and illustrate it. So I said if Company A acquired Company B, and Company B is currently undergoing a tax audit, the original owners of Company B has agreed to reimburse Company A for any future tax expense incurred as a result of that current tax audit. It has been estimated that there's a 40% chance that Company A will have to pay $500,000 as a result of the tax audit, and they'll have to pay it in 3 years' time. And let's say the discount rate is 10%. So at the date of acquisition, we will say there's a contingent liability. And remember, at date of acquisition, whether Company B recognizes this or not, at date of acquisition, we recognize all liabilities assumed, including contingent liabilities. And we say credit a contingent liability at the fair value at acquisition date, which is a 40% probability. We discount it over 3 years at 10%. And we also create an indemnification asset because the owners of entity B will pay that money. We don't net the two, we create a separate liability and an asset. Let's say 2 years later, we realize that there's now only a 30% chance of this happening. Can you see, very importantly, the indemnification asset and the contingent liability would have been remeasured every year, and the only difference would have been the discount rate. At the end of year 1, we'll have 40% of 500,000 discounted over 2 years. At the end of year 2, 40% of 500,000 discounted over 1 year. However, now the probability also changes. So we have to work on a 30% probability discounted over the remaining 1 year, and we have to make an adjustment to the indemnification asset and the contingent liability because it's more than 12 months after the date of acquisition. That journal goes to profit and loss and not goodwill. All right, so that's just an example to try and explain that. Now that is AASB 3 and a few issues that I thought I'll highlight. Some questions I've been asked over the years. However, there's also an impact on AASB 1 to 7. And I thought I'll try and deal with that as well today. I know my hour is up. If you have to leave me, thank you for joining us. If you can stay, I'll quickly look at 3 possible implications which is related to AASB 3 as well. An important point to make, there are no profit or loss implications when there's a change in interest or your shareholding, but you still have control, so you're not losing control. So let's say you had an 80% subsidiary and now you have a 60% subsidiary, but you still have control. There won't be any profit or loss implications as a result of that. So there were requirements were added to specify that changes in a parent's ownership interest in a subsidiary that do not result in a loss of control must be accounted for as an equity transaction. And previously, AASB 127 didn't deal with it, but when they adjusted AASB 3, they also adjusted AASB 127. So what does this mean? An example. So if we sell down a subsidiary, so let's say Big Limited has a 60% investment in Little Limited and the carrying amount is 60,000. And let's say Big sells 9% of that investment. They now have 51% and let's say 51% is still control. And they sell that 9% for $50,000. How would we account for it? So we are still going to consolidate. So the net assets, where in the past we included all the net assets, we would say, we include all the net assets and non-controlling interest would have been 40% of those net assets. Now we will say, listen, we still include all the net assets, nothing changes there, but non-controlling interest is increasing. In the past, non-controlling interest was 40% of net assets. Now non-controlling interest will have to be 49% of net assets. So there's a 9% increase, and therefore we'll have to say credit non-controlling interest with that 9% increase. We debit cash because that's what they paid us for the 9% interest, and we credit the equity of the parent. So remember earlier when we had a subsidiary and we bought a little bit more in the subsidiary, there was no impact on profit and loss, no impact on goodwill. This is the opposite to that. If you have a subsidiary and you sell a part of it, but it's still controlled, it's still a subsidiary, there's no profit and loss impact and no impact on goodwill or gain. However, similarly to what we did earlier, there are profit implications where there's a change in our interest that mean we lose control. So we have control of a subsidiary, we sold part of it, we still have shares, but now it's a normal share investment, or now it's an associate, so we only have significant influence. So requirements were added to specify how an entity measures any gain or loss arising on the loss of control of a subsidiary. So any such gain or loss is recognized in profit and loss. So if it's a gain, it's a profit. If it's a loss, it's a loss. There's an impact on our profit and loss. It's a bit of volatility. So any investment that's retained in this former subsidiary will now be measured at its fair value at the date that control is lost, and that fair value would now become cost for the associate or the investment for going forward. So what does this mean in an example? Let's say Big Limited has a 60% investment in Little Limited, and it's got a carrying amount of $60,000. Big Limited sells 11% of Little Limited, and the cash that they get for that 11% is $50,000. They now only have 49% in Little, and let's say 49% doesn't constitute control. To keep it simple, Big Limited therefore no longer has control. So we sold 11%. Because we sold 11%, we no longer have control. So we're going from 60% to 49%. How would we account for that? You would say debit proceeds or debit cash, 50,000. You would say debit an associate because you now have a significant influence at 49%. And you would debit that associate at the fair value. Now, how do we determine the fair value? Quickly see if you can come up with a fair value. I'll give you a second. What is the fair value of that associate, the 49%? How did I do that? Any ideas? So what I said is I paid 50,000 for 11%. What would I have paid for 49%? So 50,000 multiplied with 49% divided by 11% would give me a fair value of 222,727. Therefore, I credit the net assets in the subsidiary because in the past I accounted for the net assets. I get rid of the net assets because it's now an equity accounted for investment in associate, and the balancing figure is I credit profit and loss with 212,000. So I'm selling a part of my subsidiary. I no longer have control, and I'm recognizing a huge profit in my statement of profit and loss. All right, so this is a big implication. So just look at the previous two examples. If you go from 60% to 51%, so subsidiary to subsidiary, there's no change in control. There's no impact on profit and loss, and you can go and look at the journals. However, if we go from a subsidiary to an associate, in example Y, there's a profit and loss impact of 212,000. Now, this is similar to what we've seen earlier in the webinar. If you go from no control to control, there could be a profit and loss impact. The same way, if you go from control to no control, there's a profit and loss impact. Scary stuff. So what about the sale of an associate? Same thing. If you sell an associate and now you just have a normal investment, there could be an impact on profit and loss. And it's kind of applying this standard by analogy. If you go from significant influence to no significant influence, there could be a profit and loss impact. Same if you have a normal investment and you go to significant influence, there could be a profit and loss impact. So if you have a sell down of an associate, so let's say we have a 40% investment in an associate, the fair value is 800,000, the selling price is at fair value. If it's an associate and we sell from 20% to 20% and it stays an associate, you can see the profit and loss impact is quite small. However, if it goes from an associate to just a normal investment, the impact on profit and loss is quite severe. So you can have a look at that. The last thing that I want to say, that there's an unlimited allocation of losses to non-controlling interest. An entity must attribute total comprehensive income to the owners of the parent entity and non-controlling interest, even if this results in non-controlling interest having a deficit balance. And that is also a new adjustment to AASB 127. Right, 10 past 12. I apologize for running over time. And what I've looked at today is the core principle of AASB 3. I've also looked at some practical issues and examples on AASB 3, but I've also looked at some practical issues and examples on AASB 127, which is kind of the flip side of what we see in AASB 3 when we acquire additional interest. We see the flip side in AASB 127 when we dispose of interest. I'm saying thank you very much for joining me today. Just a reminder that we're going to take a bit of a break with the webinars for a few months during busy season, because all the auditors and all our clients are very busy finalizing and lodging financial statements with ASIC. So we'll resume these client webinars in November, where we'll talk at the latest developments to get ready for 31 December half years, or if your year end is 31 December. Interestingly, the new AASB has been issued on revenue recognition, so we'll talk about that later in the year. Hope you enjoy busy season, you get those financials finalized. Any questions, please don't hesitate to contact us at Pitcher Partners. Thank you very much. Please send me emails, phone me if you've got questions. So thank you very much for attending the session. Have a great weekend. Thank you.